we're talking about historical profitability. One thing that any lender will look at is gross margins. That is the basic measure of sales efficiency. It's like how many dollars of potential income will I make with the next dollar of revenue? What is that on average, and how does that change over time? So it's also the purest identifier of the company's ability to cover the fixed G&A costs, as we illustrated just a moment ago when talking about EBITDA margins. You've got to cover those G&A costs with your gross profits. All right, and finally, talking about historical profitability, we're going to talk about the G&A burden. So I just did an illustration where I assumed that G&A costs are fixed. The truth is there is a fixed component and there is a variable component to G&A costs. Identifying which ones are fixed and which ones are variable can help companies manage, but also can help to explain variances in EBITDA and net income by virtue of how much of those G&A costs are fixed and how much are variable. So it can help you kind of explain those marginal kind of discrepancies over time. So it's very important while forecasting, because if you're forecasting a growth in revenue, those fixed costs actually do you a favor because they stay in place while your revenue goes up and you bring more money down to the bottom line. But on the negative side, when sales are trending downward, it does the exact opposite, and that is the concept of operating leverage. All right, so we just got done talking about historical profitability and margins and all that kind of stuff. But let's take a look at the balance sheet. The balance sheet is a little bit different. The P&L is an expression of how a business has done over a period of time, a measurable period of time. But the balance sheet is a stopping point. It is basically a snapshot in time. And it's important to understand what your balance sheet tells a lender. So let's just talk about probably one of the more important concepts when it comes to balance sheet discussions, and that is the concept of balance sheet leverage. There are two types of leverage. One is cash flow leverage. We're going to talk about balance sheet leverage here. So let's assume that you have a company with 10 million in assets. I'm going to leave out the millions, but we'll just assume there are 10 million assets. And you have 7 million in liabilities. Okay, so that leaves 3 million in equity. 10 minus 7 is 3. So to calculate leverage in this very simplistic example, and I'm trying to keep it simple here, I'm going to assume that all liabilities are funded debt. But to tell you the truth, there's going to be accrued expenses in there. There's going to be accounts payable. But we'll just assume for this simple example that it's all funded debt. So basically the calculation of leverage is debt to equity, which would be 7 divided by 3. And I'm cheating here. That's 2.33. That is an expression of how much debt you have for every dollar of equity. 2.33 is pretty good. It's pretty low leverage. Banks usually like between, like somewhere under 3.5, and some conservative banks might be under 3. So now let's look at another example. Another company has 10 million in assets, and they have 8 million in funded debt or liabilities for 2 million in equity. If you take debt divided by equity, you get 8 divided by 2, and that equals 4 times. This is clearly outside of what the bank would be interested in. So when you're going to a lender, it's very important that you understand where your leverage calculation would be, how that lender calculates leverage. Now, let me just go back. I am using all of liabilities as funded debt. The truth is that a lender would usually back out things like accrued expenses and accounts payable, and they'll look at just funded debt as their measure of liability. But it's the same calculation. You take that number and you divide it by the book equity on the balance sheet at a point in time, and you will get the leverage. If it's over 3 or 3.5 times, it's not a bank deal. If it's under 3 or 3.5 times, then there's a good chance that if that were the only piece of information that were important, then you might be able to get a bank deal, or at least it wouldn't eliminate you from bank financing. However, there's lots of other issues as we're talking about this in a broader context with the requirements of bank financing. Okay, so we just talked a little bit about balance sheet leverage. I hope that illustration was straightforward. Let's talk a little bit about negative equity. So there are regulations about lenders lending to negative equity companies. Banks typically won't do it at all. Even in the asset-based world, what I've found is there's a trend for asset-based lenders that are affiliated with banks to have more difficulty lending to negative equity companies. But I think the big question when talking about negative equity is why? Why is there negative equity? There are a lot of good companies that might have negative equity. For instance, technology is one of those types of companies. In the early stages, a company may spend all of their equity, just developing products and technology for future use, but it could have a negative impact on the balance sheet in that the assets are less than the liabilities, especially, obviously if this has been funded with some form of debt. Another aspect when it comes to negative equity is, in answering the question why, is it because the company hasn't earned money, or is it because the ownership has sucked all the money out of the company and has distributed away all of the profits, which can also cause negative equity after the sales start to downturn and you have losses, then those losses can translate into negative equity. So lenders will look at the reasons why equity is negative if it in fact is negative. And certainly this is not a subject for bank financing. This is going to go outside banking channels, typically when there's negative equity situation. Another thing to consider, and this has nothing to do with the negative equity on the balance sheet, but it has to do with the relationship between current assets and current liabilities. A lot of times, if there's a line of credit in play and it becomes due and payable, it'll go up into current assets, or if a loan has been called, a term loan has been called, and it's in default and the forbearance has not been signed. In extreme situations, a bank may demand payment, and that means that instead of it being a long-term liability, and now it is a current liability, and that single move can mean that your current liabilities outweigh your current assets, which means that you're currently insolvent, meaning that if you had to liquidate your current assets, there would not be enough to cover your current liabilities. So another thing when you look at balance sheet condition, and this kind of dovetails with the concept of collateral, look at the assets alone. If you look at the assets alone, a lender can tell you whether he's the right lender or whether he's not the right lender based on the composition of the balance sheet. What are the strengths in your deal? What do you have to offer the lender? If you have good, strong assets, for instance, receivables from institutional grade account debtors, then those are good, strong assets and they're worth leveraging. Now, you may not have had the kind of credit facility that would honor those, but going forward, you may have to change your thinking and you may have to find new ways to leverage the strengths on your balance sheet to attract the right kind of lender that can take you forward to the next step and get you through the turnaround. Conversely, when you're looking at assets or liabilities, look at the liabilities. Look at the liability section. How many tranches of debt do you have? Is there owner sub-debt? Look at the weaknesses in the deal. What problems are we trying to fix? Typically, when you're doing a debt restructure or your bank is kicking you out, you're going to be dealing more with the liabilities and how to structure those liabilities. So again, thank you for watching. I appreciate you being here for this episode on navigating the world of alternative finance. My name is Kevin Pierce. I'm the president and CEO of Caldez Financial. Please join me on the web at www.caldezfinancial.com or shoot me an email with any feedback that you've got to kevin.pierce@caldezfinancial.com. Thanks for joining me, and we'll see you next week.